Hey friends, welcome to today's Singapore Market Digest. I'm Iggy from the Investing Iguana, and today we're looking at some interesting movements in the Singapore market. We've got quite a bit to cover, so let's dive right in. First up, we've got some drama unfolding at City Developments Limited, CDL, one of Singapore's largest property developers. CDL lifted a trading halt on Monday, and boy, do we have a story for you. It's like a soap opera playing out in the boardroom. So here's the scoop. Sherman Quek, the younger son of billionaire Quek Leng Beng, will remain as the CEO of CDL. Now you might be thinking, Iggy, what's the big deal? Well, last week, CDL's chairman and family patriarch Quek Leng Beng sued his son Sherman and other board directors. He accused them of leading a boardroom coup against him. Talk about family drama. For those who might not be familiar with CDL, it's a real estate giant with properties all over the world. They're listed on the Singapore Exchange under the ticker CO9. CDL has been around since 1963 and has grown into a global real estate powerhouse. They've got everything from residential and commercial properties to hotels and shopping malls in their portfolio. Now, this family feud is something we need to keep an eye on. Why? Because internal conflicts like this can sometimes impact a company's performance and stock price. Investors often get nervous when there's instability at the top. But for now, it seems like the company is trying to maintain business as usual by keeping Sherman Quek in his role as CEO. Let's move on to our next company, the Straits Trading Company, or STC for short. STC has been around since 1887, starting as a tin smelting business. Today, it's a diversified investment company with interests in real estate, hospitality, and resources. You can find them on the SGX under the ticker S20. STC just released their financial results for the fiscal year 2024, which ended on December 31st, 2024. The company posted a loss after tax of $7.2 million. Now, before you start thinking, oh no, they're in trouble, let me put this into perspective. This is actually an improvement from their $28.6 million loss in the previous year. So, they're moving in the right direction. What's behind this improvement? Well, STC says it's mainly due to a net fair value gain from their investment properties. In simple terms, the value of their real estate investments went up. However, it wasn't all smooth sailing. They also had a fair value loss from something called the derivative component of exchangeable bonds. Don't worry if that sounds like financial gibberish. It basically means they lost some money on a specific type of financial instrument. The key takeaway here is that STC is showing signs of recovery. They're not out of the woods yet, but they're making progress. This could be a good sign for investors who've been patiently waiting for a turnaround. Now, let's shift gears and talk about some interesting developments with Hawpar Corporation and United Overseas Insurance, UOI. This story is all about shareholders flexing their muscles and trying to unlock more value from their investments. First, a bit of background. Hawpar Corporation, trading under the ticker HZO2, is a healthcare and leisure products company. You might know them for Tiger Balm, that minty ointment that seems to cure everything from headaches to mosquito bites. UOI, on the other hand, is the insurance arm of United Overseas Bank, UOB, one of Singapore's biggest banks. UOI trades under the ticker U13. Here's where it gets interesting. Some minority shareholders of UOI have proposed a couple of resolutions for the upcoming annual general meeting. They want UOI to distribute its 4.27 million shares in Hawpar to UOI shareholders. They're also calling for an independent financial advisor to be appointed to find ways to unlock more shareholder value. Now, why is this important? Well, these shareholders represent about 4.5% of UOI's total shares. That might not sound like a lot, but in the corporate world, it's enough to make some noise. They're essentially saying, hey, we think there's more value in these Hawpar shares if we own them directly rather than through UOI. This kind of shareholder activism can sometimes lead to significant changes in how a company operates or how it manages its assets. It's definitely something for investors in both Hawpar and UOI to keep an eye on. Speaking of stock prices, Hawpar closed at 12.71 on Friday, down 0.7% or $0.09. UOI also saw a slight dip, closing at 7.40, down 0.7% or $0.05. These small movements might not seem like much, but they could be the calm before the storm if these shareholder proposals gain traction. Last but not least, let's talk about UMS Holdings Limited, a precision engineering firm that serves the semiconductor industry. UMS trades under the ticker 558 on the SGX. UMS just released their financial results for the fourth quarter of fiscal year 2024, and I've got to say, it's a bit of a mixed bag. The company posted earnings of $11.1 million for the quarter. Now, that might sound pretty good, but here's the catch. It's actually a 29% drop compared to the same period last year. Why the decline? UMS says it's due to lower revenue and higher expenses. In other words, they're making less money while spending more. That's not exactly a recipe for financial success. Let's break it down a bit more. Their earnings per share, EPS, for Q4 FY 2024 was 0.0146 dogs. To put that in perspective, it was $0.0234 in the same quarter last year. That's quite a significant drop. Now, before we start panicking, let's remember that the semiconductor industry can be pretty cyclical. It has its ups and downs, often influenced by global demand for electronics and technological advancements. So 1 quarter of lower earnings doesn't necessarily spell doom for UMS. However, investors seem to be a bit cautious. UMS shares closed at $1.02 on Friday, down 1% or $0.01. This was before the financial results were made public, so it'll be interesting to see how the market reacts to this news in the coming days. For those thinking about investing in UMS, it's worth considering the broader context of the semiconductor industry. Despite some short-term challenges, the long-term outlook for semiconductors remains positive. With the increasing digitization of our world and the rise of technologies like artificial intelligence and the Internet of Things, demand for semiconductors is expected to grow. That wraps up our Singapore Market Digest for today. We've covered quite a bit of ground, from family feuds at city developments to shareholder activism at UOI and Hallpar, and the ups and downs of companies like Straits Trading and UMS. Remember, friends, the stock market is always full of surprises. What we've discussed today are just snapshots of these companies at this moment in time. Always do your own research and consider your personal financial goals before making any investment decisions. This is Iggy from the Investing Iguana, signing off. Until next time, keep your eyes on the market and your investments balanced. Happy investing, everyone!